there. And okay. All right, we're on page 271. Here we go. Question 1. Which group of legal instruments may legally be prepared by a licensed real estate broker? Hey, what'd you get? It is C. And you'll notice, look at the other ones. You see deeds. You see promissory notes. Can't prepare those. Other one says mortgages, promissory. No, none of those. Correct answer is C as in Charlie. Listing, buyer agreements, sale contracts, option contracts. Failure to comply with the statute of frauds, B, would have to do with whether the contract is in writing, and that's what the statute of frauds is all about. Contracts transferring ownership rights in real property, like deeds, mortgage instruments, option contracts, sale and purchase contracts, and contracts that are not to be completed within 1 year of the date created, like lease, listing, and buyer agreements for a term of longer than 1 year. The rule is, according to the statute of frauds, the requirement, they have to be in writing and signed to be enforceable in the court of law if something goes wrong. Number 3, which contract does not come under the jurisdiction of the statute of frauds? We just reviewed this, and it's A, because of the time period, 1 year or less. It says lease, listing, buyer agreements for longer than a year must be in writing and signed to be enforceable. A valid real estate sale contract, what? A, contains all of the essentials and is in writing. Think of the acronym COLIC, will help you remember. Competent parties offer an acceptance, legal purpose, in writing and signed. That's the statute of frauds requirement. And consideration. There are 2 types of consideration. We'll be tested on that in just a moment. 5, an adult contracting with a minor just doesn't sound right. No Diddy. Is an example of failure to meet which essential real estate contract would you get? Correct answer is competent parties. D as in Delta. Good job. Number 6, canceling a daughter's property indebtedness in a contract due to love and affection, keywords love and affection, is an example of good consideration, keywords love and affection. That's what you exchange it for. A contract that is not in writing is called parole, verbal, oral, all mean the same thing, that it's not in writing. Also informal. Number 8, when a contract has been formed but an undertaking, that's an obligation, remains to be performed by one or both parties, this is an example of executory. When a contract has been completely performed, executed is what we describe it as, if you remember that. 9, which statement is false regarding counteroffers? Yes, it is D, because we know the person giving is the offer or the person receiving is the offeree. But as we make counteroffers to one another, we change roles, positions within the negotiation process. If I make an offer on your property, I'm the offeror, but then you counteroffer me, now you're the offeror. I'm the offeree. An offer is not terminated by D, an extension. D is in Delta. 11, a closing is scheduled for next week. The broker would like the closing agent to prepare a check payable to the associate for their share of commission. What's true? Correct answer is D as in Delta. The broker must provide specific written instructions to the closing agent as to the amount of commission that is to be paid to the associate, their share of commission. 12, a woman gave an exclusive, okay. Let me paraphrase this. Does the listing contract give the real estate agent the ability to accept offers on the seller's behalf? No. Your duty is to present what? All offers. So what answer reflects that? C. C as in Charlie. Yep. Good job. Exclusive right to sell doesn't give you the authority to accept offers on that individual's behalf. Good job. 13, I'll read it out. A man and a woman enter into a written agreement. The man is going to mow the woman's lawn every week during the mowing season, every 3rd week during the winter. In the middle of the summer, the man has back surgery. He breaks his back. Wow. Hands over his lawn maintenance contracts to a friend who assumes responsibility for all the man's customers for the remainder of the contract period. This is called what? Assignment. Assignment of contract. And all parties must sign the novation agreement to solidify that. 14, which applies to exclusive right of sale listing? All of the above. You got it. D is in Delta. 15, which disclosure regarding radon is required when purchasing or leasing real property in Florida? Yeah, simply put, D. A disclosure statement in the contract explaining radon gas, and that's it. You fulfilled the requirement. 16, a real estate sales associate must disclose to a prospective buyer that, yes, it is. The longest answer, C is in Charlie. Family room addition does not comply with local building codes. 17, normally a sale contract involving real property God bless you, contains a provision that in case of breach by the buyer, the earnest money deposit will be regarded as, yes, it is. B as in Bravo, liquidated damages, in this case, to the seller. So if we're talking about the deposit and the deposit only being claimed, liquidated damages. If something beyond the deposit is being claimed, now we're talking about compensatory damages. The most advantageous type of listing from the broker's point of view is the exclusive right to sell. 19, which statement is false concerning Florida's building code violation disclosure? Correct answer is A. The seller is responsible for the costs associated with the code violation. No, because we know the Florida statute does not require that you solidify it prior to the closing. You could sell a property as is with an existing. You just have to provide disclosure. 20, a couple have decided to make a written offer to purchase a home built in the 1950s, which task is not required before signing the sale contract. Yes, because they don't have to have the home inspected for LBP. They just need to receive the LBP disclosure. All right. How'd you guys feel about those questions? Real estate contracts, pretty straightforward. Let's move on to Unit 12, which was our introduction to financing. And there was a little bit of math here as well, which we'll discuss together. So we're on page 283, question 1. In a mortgage transaction in Florida, the legal evidence of personal debt is the B, promissory note, also known as just the note, even called a mortgage note or a bond, sometimes even called the paper. Has several names. That's why if a lender sells your paper, they're selling your debt obligation. This happens a lot. Number 2, a type of seller financing in which the seller retains legal title until the buyer has repaid the debt is contract for deed. C is in Charlie. Good job. Number 3, in title theory states, which Florida is not, the mortgage clause that provides that the conveyance of title to the lender is defeated when all the terms of the agreement have been fulfilled is the C, defeasance clause. You're defeating your debt. Number 4, a home was purchased with a down payment of $50,000, loan of $200,000, 6% interest, 20 years, monthly payment does not matter because they're asking us for the LTV. You could take out your handout for a calculation of LTV. Very simple. You take the loan and divide it by the value, loan to value. That's how simple it is. The name gives away the formula. What's the loan? They tell us 200,000, and you divide it by the purchase price or value, which is what? 250,000. How do we know it's 250,000? Exactly. You take the 200, which was the loan, right? And you simply add the 50,000, which was the down payment. And that gives you 250,000. Just so we're not confused about this. And so that we're clear. And when you do the math, you divide, you get 0.8, which is how much percent? It's 80%. It's 80% LTV, loan to value ratio. So what is that 80% telling us? It's telling us, look up here, that the loan is 80% of the purchase price. That means the lender financed 80% of the purchase price. That means you came out of pocket. Your down payment was how much percent? 20%. But we already know the dollar figure, don't we? Which was 50,000. That was your down payment. They told us within the question. Not always, but in this case. Correct answer is D as in Delta. 5, a borrower who is in default on a mortgage is allowed to prevent the lender from foreclosing on the property by paying the mortgagee the delinquent principal and interest, plus any expenses that the lender has incurred by attempting to collect these payments. The right is called C, Equity of redemption. Keyword redemption, you're redeeming yourself. 6, a lender declares all the unpaid balance due and payable as a result of default. The lender is exercising the acceleration clause. So if you default and the lender wants you to pay the remaining balance, they're accelerating the due date to pay it all off. That's the acceleration clause. 7, the person who borrows money to help pay for the purchase of real property is called at various times the mortgagor, the borrower who's always poor, and the mortgagee has the yes, you got it, money. Number 8, when a vendee buys subject to the mortgage, what'd you get? It is D. The vendee buyer is not responsible for the note because subject to means that the original borrower is still responsible for the debt obligation on paper, but then they have a contract with the investor that says they're going to make their mortgage loan payments for them. They don't want to trigger the due on sale clause. 9, a couple has just made their final mortgage payment on their home. What document must a lender file on their behalf? Satisfaction. Within how many days? 60. Good job. Good job. 10, if a lender does not want the mortgage to be paid ahead of schedule, the lender will impose what clause? Prepayment penalty, which we don't like. A is an alpha. 11, a buyer agrees to purchase a property with an existing mortgage lien. In which situation is the new buyer the only party responsible for the debt? Correct answer is yes, C. Assumption with novation. Assumption just describes it. Novation solidifies it. 12, the LTV is 80%. A buyer wants to acquire a property with a purchase price of $116,000. What's the down payment? Look how simple it is. If the purchase price is $116,000, which we know it is, and the LTV is 80%, the loan is 80%, what percent is the down payment? Yeah, 20%. All you had to do is multiply by 20% and you got your answer, which was $23,200. And that's your down payment. Is that one of our choices? Correct answer is B as in Bravo for that reason. If you understand what LTV is, then you can figure out what the down payment percentage is. All right. Let's continue. 13, the primary purpose of an estoppel certificate is to verify the loan balance. C as in Charlie. 14, when a lis pendens is filed properly with the county clerk, it becomes a type of C, constructive notification when you record notice in the public records. They also call this a legal notice. A couple purchased their home for $125,000. They financed the purchase with 80% conventional loan. That's your LTV, by the way. The lender charged 2.5 points. Calculate the actual cost in dollars of those points. And we could take out our handout and plug in the information. Mortgage discounting and point calculations. We know it's cost in dollars. And you'll even notice right here on the handout, I included those trigger words for a reason. You see cost in dollars right here? So that phrase, how they word it in the question, should help guide you towards the correct formula, because we're two calculations for points. Cost in dollars and lender's yield. You'll see another question about that. So pay attention next time. Anyhow, when it comes to cost in dollars, what do we need to know? Each point is equal to 1% of the loan, not the what? Not the sale price. So if it's 1 point they're imposing, it's 1% of the loan. That's how you calculate the costs in dollars. So what's the loan? They tell us within the question. Not directly, but they tell us. $125,000 is the purchase price, but was financed with the 80% LTV. So that tells us the actual loan is what? It's 100,000. You understand why? So that's what we needed to calculate. So the loan is 100 and points are calculated on the loan. So we needed it. And they're charging how many points? 2.5 points. If you convert that, it's a 1-for-1 conversion. The conversion is simple. 1 point, 1%. 2 point, 2%. 2.5 points, 2.5%, right? 2.5% of the loan. In decimal form, that's 0.025. And when you do the math, yes, you get the cost in dollars of those points. $2,500 is what you got. Is that one of our choices? Correct answer is C as in Charlie. Yep. Any questions here? All right, let's move on. 16. A borrower defaulted on a mortgage encumbering an apartment complex. Once the foreclosure proceedings were filed, the lender appealed to the courts to appoint a receiver through the receivership clause. The rule of thumb used to convert discount points to annual percentage rates of interest is that each point will increase the lender's yield. You see the verbiage, lender's yield by 1/8%. That's on your handout. Let's apply that rule of thumb for the next question. 18. A lender charged 7% plus 3 points. What's the approximate yield on the loan? You see the verbiage once again. And that's going to be this handout. Once again, we'll see lenders yield by points. So now you're going to start paying attention. What's the true interest rate? 7%, right? Plus how many points? 3 points. Let's convert those 3 points. Take 3 points, multiply by 0.125 as a percent, or 1/8%. That's just in decimal form. Go ahead and do the math. Take 3 and multiply it by 0.125, and you get 375. That's a percent. Yes, so 0.375%. And now we simply add. Our true interest rate, 7% plus the additional amount because they're charging us these 3 points, so it affects our annual percentage rate of interest. And when you add those two figures together, yes, you get the correct answer, which is 7.375. Is that one of our choices? Let's see. In our textbook, yes, this B is in Bravo. Unfortunately. You have a loan with a principal and interest of $846.21. The lender requires an impound account for taxes and insurance. What is your total monthly mortgage loan payment if your property taxes are $2,840 and your annual insurance is $1,570? So we can do it this way, or we can do it separately. Either way, we're going to figure it out. So what's the annual amount of property taxes? $2,840. And what's our annual insurance? $1,570. We need to get those to a monthly figure. So we simply divide by what number? Divide by 12. Do the math. Tell me what you get. So when you take 2,840 divide by 12, what do you get? 236 and 6. 6 continues on. Okay. You want to be as accurate as possible until we get to the end. All right? Because we don't round until we get to the end. Anyhow, we have the annual insurance, $1,570. Divide that by 12. Exactly. 130 and 3s to infinity. All right. Now we take that amount and simply, we got to add all of these figures together. What's our monthly principal and interest? They tell us $846 and 21 cents. You add the monthly property taxes, 236.6666, okay? And then add it to your monthly insurance, which is 130.3333. Continues on. Add those figures together, and now you can round to the nearest cent. What do you get? 1,213 and 71 cents. So one of our choices. Correct answer, yes. D is in Delta. And I don't have to show you the math for number 20. I can just explain it to you. If the property value is $350 and you leveraged against it for $300, What's left over? How much equity do you still have? You got 50,000. Correct answer is A as in alpha. Number 17. A as in alpha. All righty. Let's get started with our session for today, which is going to be Unit 13. It's going to be the longest unit in the textbook. Unit 5 is the most important. Unit 13 is the longest. And it used to be the shortest unit in the textbook. What they did was they combined the most important parts of 3 separate units into this one unit. But fortunate for you, because I'm your instructor, I'm not going to combine 13 and 14 in the same session. What I'm going to do is I'm going to combine the longest unit in the textbook, Unit 13, with the shortest unit in the textbook, which is Unit 15. Cut you guys a break, because if I combined it with 14, which is teaching chronologically, which you already know I don't do, I rearrange the order of these units to your benefit. Unit 14 is all math. So imagine covering the longest unit in the textbook and saying, okay, well, we're not done yet. Now let's do the majority of the math that you're going to see on your exam. You're going to hate me at the end of the session. And I don't want you guys to quit on me. So let's go ahead and work on 13 and 15. If we have some extra time, maybe we'll squeeze in an additional unit and it will save us from covering it later on. But let's start with 13. All right, 13. We're going to take a deeper dive into mortgages and where our money comes from, how lenders lend money, where they get their money from to eventually lend to you, the arbitrage they play. It's all a game. It's all a money game. If you're not familiar with the process, this is the steps you would typically go through to qualify for a loan. First step is by submitting your loan what? Application. You don't have to highlight this. It's just general information. But as a practicing real estate professional, just to have a general understanding of how the process works, it's important. If you go to page 297, next step, credit what? Yes, credit history. Next step, qualifying ratios. These are debt to income ratios. Have you ever heard of debt to income ratios? Making sure you have enough income to satisfy the debt of purchasing this property you're interested in acquiring. We'll come back to that math. Qualifying the property, which may be a step depending on the loan program you have, like FHA and VA, which we'll discuss in a moment. And before you go shopping, what letter do you need? Pre-approval. Exactly. And your offer will not be considered unless you have the pre-approval letter attached to it. If you're getting financing to purchase, if it's cash, then you need verification of funds. So let's jump into it. Mortgage loans, look on line 31, are grouped into 2 categories, conventional and what? Here's the basic difference. Conventional loans are loans that are not backed by the government. You'll see that here, first sentence. Which means, look on line 33 at the end, the lender assumes the full risk of default if the borrower cannot continue to pay. Versus non-conventional loans, which are loans that are backed by the government. And there are 2 in particular that we're going to discuss. FHA insured, this is the full name, and VA what? Guaranteed. We'll come back to these. But let's begin with conventional loans. Very popular. And let's discuss the features. Of course, the interest rate, that's how they make money off of you. It's based on your qualifications. Let's talk about what we see on the next page, line 1. VA loans, I'm sorry, not VA loans, conventional loans is what we're talking about. You'll see right here, fixed rate conventional loans usually include a what clause? Do you remember the due on sale clause? It prevents assumption of mortgage. If you have the due on sale clause and you try to transfer ownership in that property, the due on sale clause gets triggered and the lender says, I want the remaining balance right now. But if it's a adjustable rate conventional loan, they are assumable, which we'll discuss later on in this unit. We'll come back to it. Prepayment, pay off as early as you like. Nice. We discussed that in Unit 12 yesterday. Down payment and PMI. Now, most lenders that offer conventional loans, this loan program, want you as a borrower to contribute at least what as a down payment? Look at the percentage here. You see 20%? So most of them will give an 80% LTV. They want you to come out of pocket for 20% of the purchase price. It doesn't mean that we haven't seen conventional loan products with down payments as low as 5%, sometimes even less than that. It's up to the lender. But if you cannot come out of pocket with at least 20% of the purchase price as a down payment, the lender will tack on something because they're viewing you as more risky. And that's called PMI. Have you heard of PMI? Well, now you've heard of it. PMI stands for private mortgage insurance. So they essentially make the borrower pay for insurance to protect the bank just in case the borrower what? Defaults, stop paying. Once again, that's the magical threshold. They want you to contribute at least 20% as a down payment. If you can't, they could still give you financing, but they're going to charge you PMI because you're viewed as more risky. Are you with me on that? Now, for the last property that I acquired as a primary residence, I had PMI because I wanted to keep the extra cash in my pocket. They said, you qualify for 5% down. I'm thinking, great. More money in my pocket. I don't have to contribute 20%, but with the anticipation that they're going to charge me for PMI. And I'm paying towards PMI every single month, almost $400 every single month towards PMI. And the debt was not much, $320,000 at the time. And I'm still making these payments of $400 every single month towards PMI. I got sick of it. I'm thinking I'm wasting this money because I had the 20%, but I was stubborn. I wanted to keep it in my pocket because I liked seeing the cash, or I wanted to invest, or whatever the case may be. So I'm thinking, can I remove it? The answer is yes, you can remove it. After 2 years of good behavior, on-time payments, you can request to remove it. And you have to have, at that point, at least 21% equity built into the home. Pay down the debt by at least 20%, essentially. And they'll do an appraisal to confirm this. And if you do have at least 21% equity in the home, they will remove the PMI, but they do not make it easy for you because they love receiving these payments. They love getting this extra money from their borrowers every single month. You don't think they have additional protection besides this? Of course they do. Too big to fail. Have you ever heard of that before? The mortgage crisis, housing market crisis, and everything, and the bailout. Okay, homework tonight. Watch that movie, The Big Short. It's going to help you wake up and understand what happened in the past. And everything is a bubble, what you'll find out. And we'll discuss more of that later on. So if what we said is true, as a conventional loan, how much of an LTV do lenders for conventional loans usually offer if they want you to contribute at least 20% as a down payment? Yeah. Okay. But any more than 80%, and it's going to trigger charging you PMI. I'm just reviewing with you guys. I'm repeating it so you can hear it again. We're going to come back to this qualifying for conventional mortgage loans. These are debt to income ratios, but you are going to be tested on this for your homework tonight and for your class exam. 2 separate questions. Go to page 299. You'll see it. Lock that in. That means the internet's going to go out. Can you guys still hear me online?
Yes.
Yes.
Yes? Still coming in loud and clear? All right. It looks like the electricity just reset. So I want to make sure that we still have a good connection. All right, let's move on. Let's go to page 300. And on page 300, you see common types of mortgages. Let's go through this list together. You'll see two most common types of conventional mortgage loans are fixed rate amortized and adjustable rate mortgage loans. Have you ever heard of an amortized mortgage? Okay, let me explain it to you. It's where your monthly mortgage loan payment consists of at least two parts. What are these two parts? We'll see it in front of us on this list, starting on line 18, interest, and on line 22, principal. So your mortgage loan payment will consist of at least those two parts. But let's unpack each one of these features and better understand what it means. If you look up here, I can easily explain it to you. The principal portion of your payment that you make every single month goes towards killing your debt. Interest is the portion that kills you. You get it? This is the part that's going in the bank's pocket. This is what they're making off of you for giving you the loan. It does not kill your debt. It goes in the bank's pocket. Now, in the beginning of the loan term for an amortized mortgage, which is how they're normally structured, the majority of your $2,000 payment, I'm just making this up, $2,000 payment, the majority of that $2,000 is going towards what? Principal or interest? Interest. The lesser portion going towards principal, towards actually killing. But it doesn't remain at that equilibrium, essentially. They change places over time. So the principal portion of your payment is going to increase while the interest portion is going to decrease, even though your monthly mortgage loan payment is the same. They call this a level payment plan mortgage loan, where your payment stays the same, $2,000 every single month, but within it, interest and principal change places. I'm going to show you how this works. Go to page 301. Here's an example of a $200,000 mortgage loan at 4%, 30-year term. This is a level payment plan mortgage. How do I know? What we see on the left is the first 6 months. And if you look in the second column, it says monthly principal and interest payment. That's PI. And you'll notice it stays the same. Isn't it consistent? $954.83. So just like we explained. But in month number 1, how much is going in the bank's pocket? Yeah, the majority of that payment. And the lesser portion is actually going towards killing your debt. Only $288.16. And look what we do. We start off with $200,000. We subtract $288.16. This is our balance. You see balance? And then you repeat that calculation every single month. So you're barely chipping away at the actual debt, and you don't really start killing your debt exactly until you get towards the end of the loan term. And you'll see that with the last 6 months, your payment amount stays the same, but look at how much is going in the bank's pocket versus how much is going towards actually killing the debt. And that's why people, when they see this, because this is handed to you, it's called the amortization schedule when you close on the loan. They say, okay, at any point, month 36 of paying off your debt, making your payments consistently every single month, you can see how much debt you have left. But people don't like this. They want to speed up the process. So borrowers will make additional payments directly towards what? Principal or interest? Principal, to kill their debt that much quicker. But you might be thinking, okay, well, does that lower my interest? No, it doesn't affect your interest rate. Does that lower my payment every single month? It would be nice, but it doesn't happen like that either. You're basically just chipping away at that 30-year loan term. So they take it off the end of the loan. That's how you benefit. So you're paying less interest because you're paying off the loan sooner. Exactly. And there's calculations out there, and I'm sure you've followed Dave Ramsey and these people that talk about it. If you make at least one additional payment, a 13th full month payment, but take that payment and apply it directly towards principal, you'll kill your loan term by like 5-7 years, possibly even more. But how does a fixed rate amortized mortgage differ from an adjustable rate mortgage, also known as an ARM? And there's a reason why it's called an arm, because it's possibly going to cost you an arm and maybe even a flipping what? Leg. And a lot of people are suffering with these right now that got these very low rates to start off with. They call this, look on the next page, they call it a teaser rate to attract you to this type of loan program, but within the anticipation that after a certain number of years of you having this loan with them, they're going to start adjusting your rate, hence the name, adjustable rate mortgage loan. So they might lock you in for the first 5 to maybe even 10 years. This is all negotiable, by the way, and based on the program. But after that fixed term, they say it's going to be adjusted every single year after that. So what do they tie your rate to? What does your rate consist of? It consists of these 2 parts. It's right above. Index and what? Now, if I can just reverse the explanation, margin, also known as spread, represents the lender's costs of doing business plus their what? And remains constant over the life of the loan. So the amount of profit that they're making off of you within this rate is going to stay constant. But how does a lender ensure that they don't miss out on more attractive interest rates? Imagine if rates go up like what has happened over the last few years. They don't want to miss the boat on all of those wonderful new interest rates. So index solves that problem. They tie your rate typically to U.S. Treasury securities. Have you ever heard of this before? Treasury bonds, T-bills. It's government stock. Did you know that anybody can invest in the U.S. economy? Anybody. And they have these things called bonds. Have you ever heard of the 1-year, 10-year, 30-year bond? Okay, so typically they look at the 10-year bond, and based off of that, if it fluctuates, if those bond rates go up, your rate's going to be affected. If the bond rates go down, your rate is going to be affected. And that's going to be done every single year, that analysis. It could go up or down, unlike a variable lease, which we learned in a previous unit. And how do you calculate your interest rate in an ARM? Well, they just add those 2 together. And that determines what you pay. Let's continue on. If you go to the next page, what we see now is a type of non-conventional loan. We just learned that conventional loans are loans that are not backed by the government. Therefore, non-conventional loans are loans that are backed by the government. And there's 2 that we're going to discuss. The one in front of us, what's the official name? Government what? Insured FHA program. Have you ever heard of an FHA loan? Okay. This is a HUD-backed program, and we know HUD's philosophy. Exactly. So with this program, they offer more attractive terms, conditions, rate even for borrowers, mainly first-time home buyers or buyers that are purchasing a primary residence. Technically, you become a first-time home buyer every 3 years. And FHA, the program says you can buy a property as your primary, and at least if you've had it as a primary for about a year, then you can turn it into a rental, and potentially you can get an FHA loan again after that. And you'll see why most people would like to take advantage of this. It's easier to qualify for, and the interest rate is typically more competitive. It's the most competitive, in my opinion. Now, FHA is for your primary residence, residential specifically, but what is residential defined as? How many units? 4 units or less. So you're telling me that I can use an FHA loan to get a quadruplex, live in one of the units and rent out the other 3, supplement what I pay, offset my debt payments every single month? Yes. And actually, the rental income that those other 3 units could potentially generate for you helps you qualify to purchase the quadruplex. This is called house hacking. Have you heard of that? Okay, so this is a common thing. You get a duplex, triplex, quadruplex, up to 4 units for this program. Live in one, rent out the others. And the income from the other units help you qualify for it. So not just your income, or maybe not even your income. Maybe the income of the other 3 units helps you qualify entirely. But once again, the qualifications for this program are already low. Your credit score, the interest rate offered, and so forth. Debt to income ratio is higher. You can take on more debt versus what you make as income every single month. Tons of benefits. And we're going to see those features on page 304. Okay, I'm giving you some serious gems here, by the way. I don't know if you've heard of this before, but if you haven't, it's not in the textbook. I'm sharing some additional information with you that you can take with you and benefit tremendously over. We see interest rate, the most competitive interest rates for FHA loans, discount points, which they can still charge you. We discussed this in Unit 12 already. FHA loans on line 8 do not have a what clause. So therefore, FHA loans could be assumed by another borrower. So if you find somebody that can't afford to continue making their mortgage loan payments and they got an FHA loan at 2.5%, you can potentially take over their debt. That's acceptable for this program. No, this is assumption because there's no due on sale clause here, so you can completely take over it, which is pretty cool. Down payment, another reason why they're so attractive. Down payments as low as what? 3.5%. So that's some of the lowest. VA loans, loans for veterans, have 0% required as a down payment. USDA loans, 0% down. And even though we see 3.5% down, by the way, you shouldn't be purchasing a property if you can't come up with at least 3.5% down. But in addition to that, this 3.5% could be covered. Have you heard of Hometown Heroes before? Have you heard of this program that offers down payment assistance for first-time home buyers? So you compare FHA that covers 96.5% of the purchase price, and then with the remaining 3.5%, you can get government assistance to cover that as well. So you can actually walk into a property, your first-time residence, with no money down. And if you can negotiate for the seller to give some concessions, credit towards closing costs, you might even get cash back when you close on the property. And I've seen deals that are structured in that way as well. It's depending on the negotiation skills of your real estate agent, but anyhow, that's up to you to help your clients out. Loan limit. You'll see right here. The limits vary significantly depending on the average cost of housing in different regions of the country. You can look this up online. But I'll give you an example of this. The maximum FHA loan you can get in Orange County, California is a lot different than the maximum FHA loan that you qualify for Orange County, Florida. Maybe the maximum over there is 1.5 million. The maximum over here is maybe 500,000, possibly more nowadays, because housing costs are extremely high. Check this out. You'd find this interesting. Unlike conventional loans, where if the borrower came up with at least 20% down, they didn't have to pay mortgage insurance. You remember mortgage insurance protects the bank just in case the borrower stops paying? For FHA loans, you have no option. You have to pay mortgage insurance. And it's not like you can remove it later on. It remains throughout the entirety of the loan term, unless you refinance. You'll see it here. It says not only you have to pay for 2 types of mortgage insurance. You pay an annual MIP and a UFMIP. UFMIP is upfront mortgage insurance premium. It's based on the loan amount. And the beautiful thing about FHA loans, you can actually finance closing costs. You can finance closing costs. So if you don't have any money to help pay for closing costs, you can roll it into the loan and not have to pay it out of pocket up front. Isn't that amazing? Including your UFMIP. In addition to the upfront mortgage insurance premium, you have to pay an annual MIP that can be divided into 12 easy payments for you. How convenient. Anyhow, once again, you can't remove these. It must remain. unless you refinance into conventional financing. But let's continue on. Let's talk about VA loans. By the way, for FHA loans, I don't know if you're familiar with this, but they typically require an appraisal contingency. They're planning on removing this requirement, but right now they still do. So what does that mean? That means if the property doesn't appraise for what you offered and the seller isn't willing to come down, then you can back out as a buyer and get your deposit back, no questions asked. That's the stipulation that the seller has to agree to if you're bringing FHA financing to the table. So it does have a negative side to it. It puts the property through more scrutiny. The property is more judged by the lender than other types of financing. They do a special appraisal. It's called an appraisal inspection, which means it has to be habitable and it has to meet certain livable standards. Otherwise, the lender is going to say these have to get fixed prior to closing. And the seller might not be willing to play ball. They're thinking, really? I have to fix this tiny thing? They really go in detail with scrutinization of the property. So if a seller has been around the block, they've sold other property they owned before, and they entertained somebody that was bringing FHA financing to the table, they might have a bad taste in their mouth from the last transaction. And they're thinking, I don't want to deal with somebody who's bringing FHA financing. I don't want to deal with all these lender requirements. Why? If somebody's going to make an offer on my home, if they're bringing conventional financing, I'll be more inclined to consider that one versus FHA. This is the negative side of it. Your offer looks less attractive if you bring FHA financing to the table. And then think of the psychology behind it as well. If it's easier to qualify for FHA financing versus conventional, they're thinking you're not as qualified as the conventional borrower. So I'd go with this person that's bringing conventional financing because it was harder for them to get that loan. And my property is less scrutinized, and there's no appraisal inspection, and there's no appraisal contingency. Better understanding of how these transactions work. It's important for you to hear that. VA loans are loans for who? Yeah. Department of Veteran Affairs. Check this out. They're non-conventional, which means they're backed by the federal government. Let's discuss some details. Starting on line 17. Who qualifies for VA loans? Yeah. Something interesting. Unremarried surviving spouses of veterans. Unremarried. So that means if you get remarried, then you lose your benefits. Wow. So they have boyfriend, girlfriend, whatever the case may be. It's based on how long you serve for our country. You don't have to know the details of that. I'm just sharing that with you. And who can offer this program? Well, only VA-approved lenders can provide this type of financing. You can easily Google this and find a list of local vendors of this product, just like FHA. Up to 4 units. Look what it says. Program may be used to purchase, refinance, or construct 1 to 4 unit properties. Just going back to FHA loans, the most common FHA loan, there's different programs of FHA, by the way. I don't know if you're familiar with that. But the most common is 203B. That's the official name, FHA 203B. But there is an FHA program called FHA 203K. And 203K, if you inquire about this program, you can actually purchase a primary residence, get financing for purchasing a primary residence that is in poor condition. And you can actually finance renovations. So you can find a house that's beat up. They're selling it dirt cheap because it has so many problems and it doesn't qualify for traditional financing. But with the 203K program, you could say, I want this to be my primary residence, but I got to fix it up. Lender, can you finance renovations? And they'll do it with this program. It's pretty cool. Up to 4 units. Find a duplex that's fallen apart, fix it up. And then you have built-in equity when you purchase it as well. I mean, that's pretty cool. That's the way you really can play the game. All right, now we see loan guarantee and entitlement. It says VA establishes loan guarantee limits referred to as a VA loan guarantee or maximum entitlement. In the past, they required you to understand the math behind this, but it was foolish to require you to learn this because you're not giving financing. So we don't have to do that anymore. Thank God. It's a really odd calculation and not something that you would enjoy. And I don't like explaining it either because it is just inherently confusing. But the good news is, anybody serve for our country besides Elijah? Anybody else? All right. You can actually reuse your entitlement and you can get multiple VA loans. And there's no maximum for the VA loan. It depends on what you qualify for. And there's no down payment required as well. Of course, you have to qualify for that to not have to make a down payment, but it is a feature of VA loans to not have to contribute towards a down payment. That's pretty cool. Even though you have this loan for veterans, they can still charge you a loan origination fee no more than 1%. And something interesting about VA loans, look at this on line 26. It says VA loans do not require mortgage what? Insurance. But they charge you something called a funding fee. And you're probably curious, what is a funding fee? It doesn't tell you. They removed the explanation in the textbook, but I can assure you what it is. The description, the easiest understanding of it, it helps the government offset the cost of foreclosures. Well, what does that sound like? Sounds like mortgage insurance, right? To protect the bank just in case the borrower defaults. Now, to be fair, VA loans have the lowest default rate. It tells you something about the mentality of somebody who serves for the country, and there's so many benefits that come and trying to keep you employed and enlisted and so forth. I have somebody that's going to rent a property and they have a housing allowance. So the military gives them a housing allowance. I mean, basically covers almost all of the rent. It's pretty cool. Especially if you get stationed different parts of the country for basic training and so forth. Anyhow, so the funding fee, also known as a user fee, it helps the government offset the cost of foreclosures. But oh no, we don't charge mortgage insurance. They just disguise it as something else. And you'll notice if you have a disability, if the veteran has Purple Heart recipient or service-connected disability, the funding fee is waived. Okay, I guess that's a nice feature. Now check this out. Qualifying ratios. You have to know what's on this chart, but I made a handout to make it simpler for you guys. We're going to come back to this in just a moment. This is on a handout, separate handout. Closing costs. Unlike FHA loans, which FHA loans, you can finance the closing costs. You can roll it into the loan, which is nice. You don't have to come out of pocket at the closing. VA loans, you do have to pay closing costs. You have to pay outside of the loan. You can't finance them. And check this out. Just like FHA loans, VA loans do not have a what clause? Due on sale. So that means they are what? Yes, even by what? Non-veterans. So if you know somebody in the military qualifies for a VA loan with all these wonderful benefits and features that come along with it, you could potentially assume that loan with all those wonderful benefits, even though you're not of the military. It's pretty cool. A lot of people don't know about that. Go to page 308. You can pay off as early as you like. And I want you to highlight this chart just so you can see the comparison between FHA and VA loans. Distinct features. You see? UF, MIP, and then this one, VA loans, they charge you a funding fee, but they disguise it. It's not mortgage insurance. It's very interesting. All right, let me share something with you, and then let's get into a little bit of math. Let me share purpose-specific mortgage products. Have you ever heard of a biweekly mortgage loan? It's where the borrower pays every other week instead of every month. Biweekly, every other week. And you're probably wondering what's the benefit in that. First of all, they don't actively advertise these products. Yep, exactly right. Check this out, last sentence. Saves the borrower considerable interest because you're paying off the debt quicker. How? Because they charge you 26 half payments to the equivalent of 13 full month payments instead of 12. So you're making that one additional payment every single year. It's pretty cool. So major banks offer them. They just don't actively advertise them. So if you're intrigued by this, you're interested, you have to inquire. If you go to the next page, partially amortized. This is also known as, look up here on line 4, a what type of mortgage? So I've taken advantage of these. I've offered these as an investor. So as an investor, I might have a property that I want to offer seller financing, but I don't want to wait 30 years to get repaid my debt. So I'll structure it as a balloon mortgage. I'll stretch the loan payment over 30 years to make your monthly payment affordable, so you can actually afford it every single month. But at year number 5, for instance, this is all negotiable. I can say after 2 years, 3 years. But let's say after 5 years, whatever the debt is at 5 years, you have to pay me the remaining balance. So essentially, I gave them an opportunity to get their foot in the door and then be able to purchase a property where they can't get traditional financing. I finance it as their lender, as the owner of the property. But at year number 5, I expect them to get their financial situation in order and to pay me the remaining balance. Refinance, for instance, get traditional financing and cash me out. Purchase money mortgage is also known as seller what? On line 14, in parentheses, seller financing. We saw this in a previous unit. Seller financing is officially known as a purchase money mortgage. Have you heard of a home equity loan? Yeah. It's where somebody has significant equity in their home, and a lot of people are experiencing this right now, especially if you purchase property prior to the pandemic. So you might have a tremendous amount of equity, maybe 100,000. But I'm going to tell you right now, most lenders give probably up to 80% LTV for the equity that you have in your home. So if we're using simple numbers, you got 100,000, the lender's willing to give you 80% LTV. How much can you pull out of your equity? What's 80% of 100,000? I'm using simple numbers. It's $80,000. So you can pull out $80,000 worth of your equity, even though you have 100. They're not going to give you the full amount. I'm just giving you some inside information. And you could use the money for whatever you wish. You want to buy another investment property, start your business, fund your business, expand your business, whatever the case. They don't care. Home improvements, they'll ask you for the reason, but they don't really regulate. And the only issue is you're creating a second debt against the property, and eventually you have to pay it what? You got to pay it back, plus what? Interest. So that's just something you need to consider. Hopefully you're using the money wisely. You're not buying a boat, an additional liability. You're buying assets that bring you more money. Have you heard of a HELOC? Home equity line of credit. This is like a credit card for your equity. So they give you a spending limit. Imagine you, once again, you have $100,000 of equity. Let's just say it's worth $500,000, but you owe $400,000. So the difference is your equity, right? You got $100,000 equity. But instead of pulling out a large lump sum of cash, you take advantage of this. You take out a line of credit, and they'll give you up to a spending limit about 80% of your equity. So $80,000 spending limit to use for whatever you like. So it's like a credit card. You have a spending limit with a credit card, same thing with your equity. And then you pay it back. You use a little bit, pay it back, use a little bit, pay it back. Anyhow, maybe you've heard of this, maybe not, but we see a home equity conversion mortgage, also known as a reverse mortgage, or even called a HECM. And this will help you remember HECM, because it's designed for people over the age of what? 62. When maybe you're a little bit later in your years and you cough, maybe it sounds like HECM. This will help you remember. So instead of pulling out a large lump sum of cash, what you can do is with this HUD-backed program, this is backed by the Housing and Urban Development Department. They will basically allow you to pull out your equity in either a large lump sum or a little bit at a time every single month. And they do not require repayment as long as you live in the home. Keyword live. But once you pass, or if you sell, you have to pay back. Yeah, that's what we're talking about, reverse mortgage. That's exactly right. But here's the thing. Maybe you don't want to leave your kids with debt attached to property. Unless you have some type of life insurance that you know is going to cover it, and you have the property in a trust. You're not worried about the estate taxes they have to pay and so forth. So it could be worth your while if you need that additional income and you're retired and that's part of your retirement, the primary residence that you paid off. Take out a debt against it, use that money to live life. Anyhow, before we take our break, we can go back now to debt to income ratios. There are two in particular that we're going to see. Take out a calculator. We're going to work out these examples together. Housing expense ratio. We see something called a HER, used to calculate the borrower's ability to pay the housing debt for the property that they want to purchase. And then we'll see something called total obligations ratio, or the TOR, used to calculate, I printed it. Can you pass one back? Pass one down. Total obligations ratio, used to calculate the borrower's ability to pay all monthly debts. So you can see why this is important. And we're going to go through this together. As an example, first of all, let's talk about the calculation for the HER, housing expense ratio, just to see if you as a borrower can afford to cover the monthly housing debt. What does your housing debt consist of every single month? What do you pay towards housing debt? Yeah, well, what does that consist of? PITI. You know what PITI stands for? Principal, interest, taxes, insurance. And if you cannot come up with at least 20% as a down payment, what else might they charge you? PMI, which stands for private mortgage insurance. Do you remember that? Let's make it up just to see how it works. Your monthly housing expenses, $2,400. Principal, interest, taxes, insurance, everything included. And you would take that and divide it by your monthly what? Gross income. Let's make it up. Let's say you're making $8,000 a month. Do the math. This is before expenses. It's your gross income. So this should be easy math for all of us. 2,400 divided by 8,000, you get point what? You get 0.3. It's a ratio. It's a percentage. So what percent is that? It's 30%. Look at this chart, guys. This is the same chart in your textbook. I put it all in one place for you, both calculations and the chart. You have to know what's on this chart. You have to memorize these debt to income ratio thresholds. All the way on the left, do you see the three categories of loan that we discussed? Conventional, FHA, VA. But each one has their own ratio. So you'll see for the housing expense ratio, HER, which is the calculation we just did, conventional loans, they say your debt to income ratio for the HER has to be below 28%. So what does that mean? They're basically saying that your debt for purchasing this house cannot be more than 30%, or excuse me, 28% of your actual income. It cannot make up more than 28% of your actual income. So that's the cutoff. So where do we stand? We're at 30%. Do we make the cut for conventional loans? No, we're over. We have to be at or below to qualify. So we didn't make the cut. This is basically, look up here. What we found out was that your debt for buying that house was 30% of your actual income. Conventional says, well, it can't be 30. You got to be at 28 or less. So we're over. So you don't qualify for conventional at this point. It's not the end of the story yet. There's ways that you can navigate, but let's continue on. FHA loans, I told you it's easier to qualify for FHA financing. They say you could take on more debt and still qualify. Look, you have to be below 31%. Where do we stand? 30. So we qualify. We're pre-qualified at this point.
It's not gone through underwriting or any of that. And this is a calculation you should know so you can do this with your prospective buyers before they pull credit and find out that they don't qualify. You can just do this quick preliminary calculation and find out what the game plan should be. Do you qualify for that house you like? Let me show you real quick. Let me just do this calculation. Well, for conventional, you got to be at 28% or less. You're not there. But for FHA, that could be our path. And VA doesn't even look at this calculation. So let's talk about the next one, which is called the total obligations ratio. As a borrower, are you just responsible for the housing debt of that property you're interested in? No. Don't you have other debts in the month? Don't you think the lender is going to scrutinize this and review this to determine if you're pre-qualified? Of course. What expenses appear on a credit report? Credit cards, auto loans, educational loans, medical bills. Whatever appears on the credit report is what the lender is going to scrutinize to determine if you're pre-qualified. So check this out. You take your total monthly obligations, which include what? Your PITI, private mortgage insurance, if you cannot come up with at least how much percent down? 20% down. And your other debts you're responsible for in the month, like we talked about, auto loan, medical bills, whatever. They might overlook medical bills. And they might kind of put the student loan debt to the side because of all this forgiveness that's going on right now. But credit cards, auto loans, they will scrutinize. Personal loans as well. Let's say all of your debts, including that house you want to purchase, add up to $3,200 a month. So a little bit more now. So this is the housing debt and your other debts add up to $3,200. And your monthly income is still the same. It's $8,000. So do the math. Take 3,200 and divide it by 8,000 and you get 0.4. 0.4 is what percent? It's 40%, guys. So it's a total obligations ratio, a TOR of 40%. All three loans review the TOR to determine if you're pre-qualified. And conventional says, look in this column, you have to be below 36%. Are we below 36%? No, so once again, we don't qualify for conventional. FHA, are we below 43%? Yes. So we got the green light. And for VA loans, are we below 41%? If we're a veteran or active military, yes. Here's the thing. Yes, initially you see that the borrower that you're working with based on these numbers does not qualify for conventional, but it's not the end of the story. Could you advise them and ask them, hey, do you have some extra cash that you saved up? Can you make a greater down payment so that way your loan is less? That means not only do you have to, you don't have to pay the PMI, also your monthly mortgage loan payment is going to be less. And if we bring down this amount, then it would change the ratio and you could get below the 28%. That car that you have, do you have enough money saved up where you can just pay off the car? Can you pay down that credit card and then wait until it reports to the credit bureau so that way we can then go to a lender, pull credit, and it's not even going to be a question because they'll see on the credit report it's paid down. So let's use the numbers that you would give the lender anyway, but give it to me. I'm on the same team as you, and I'll show you how we can game plan so that way you're not wasting your time and then we're caught behind the 8 ball and have to go to credit repair and do this. And let's do it beforehand. So that's how you can advise. Any questions about this? Very simple calculation, but it is something you're going to be tested on for your homework tonight. Let's take a quick break. Be back at 6:20. 6:20. 10 minutes. Stretch out. Grab a snack. Do what you got to do. See you guys in just a moment.
Hi, my name is Crystal Rivera, and I'm a realtor with Live Realty at Nona. I decided to be a real estate agent for my love of helping others, thinking about helping them with their first home, with their first apartment, with their first investment property. Flipping homes is what started me in the business. My husband is into flipping homes, so I went from nursing, which I'm still currently doing, but now going into real estate. Decided to use Cameron Academy because of my nursing schedule and how their schedule works well with my schedule. Did not expect to be prepared as I was. Michael was amazing. He prepared me in 2 weeks to take the test, literally 5 days after I completed the class. And 3 days after that, I was already signed with Live Realty. And here we are 5 weeks later, and I have my first listing. So definitely prepared me well for the real estate industry and just all that's to come. I'm excited, and I wish everybody luck.
Hey, my name's Jonathan Gibson. I am from Orlando, Florida. I had started my career in real estate based on wanting to... I started out my journey in real estate with Cameron Academy because I read a lot of online reviews, and there were exceptional reviews about Cameron. When I got here, I wasn't disappointed at all. I realized Michael was the best teacher, and he helped me learn everything I needed to know about real estate. And he's a very good instructor. He's thorough. He tells everything. He's one of the better professors. He's good at explaining stuff, helping you get through this and making it easy for everything. And I wanted to do real estate because I read some books and I bought homes, and I wanted to start renting out my property. And I know we had, based on my research online from Google and everything, I knew I had to do a school for Florida and do the 63-hour course. And I looked it up, came to Cameron Academy. It's been the best thing ever. He's helped us with connections. He's brought in different realtors and brokers, plus find work after the academy. So if you're wanting to learn anything about real estate, I would definitely recommend Cameron Academy.
Hi, my name is Tamara Fletcher, and I have experience in education. I've worked in education for over 17 years, but I always wanted to get into real estate. I wanted to get into real estate because I love a couple of things. I love people, I love making money, and I love being able to sell homes, or at least the potential of selling homes. I love real estate. That's what brought me to Cameron Academy. Cameron Academy has done so much for me. I have learned so much from Michael. The information that I've gained here has made me feel so prepared for the state exam as well as the exam at the end of the course. I can't go on enough about how enthusiastic Michael was during the whole process of learning, and how that really made a difference in the way that I learn. Being able to be here in person and take the in-person classes is what has really made it all the difference in the world. Michael is a great instructor. I saw great reviews about him and his instruction here at Cameron Academy, and I am really happy to say that all of those positive reviews are true, 1,000%. It's made a world of difference for me, and if I could do it again, I would.
My name is Gabriel Minyarji. I've been in the restaurant industry for the past 25 years, now getting the residential investment opportunity. I found Cameron Academy to be very helpful in my new endeavor. Michael Cameron has been very, very helpful, knowledgeable, provided very new and efficient information to help me endeavor my career. I'm very, very pleased and satisfied that I found Cameron Academy and the knowledge that I gained from them, and for all my future endeavors. I highly, highly, highly recommend them. I definitely give them a 5-star plus.
My name is Dennis Duen. I came to the Cameron Academy. My mentor, he also he told me go directly to Cameron Academy. They are very, very good, and that's how he got his license. And he advised me to go to that school. And when I came, so far, it was the best decision that I made. The instructor Michael was very, very good. He's very good, and it would benefit me. Very knowledgeable. So I want to say thank you to him. And I think I will pass because of him. I will pass both school exam and the state exam. So it was the best decision that I made. Michael was very good, and I want to say thank you to him. Thank you.
Hi, my name is Samuel Ramirez. I'm an electrician. I got into real estate to get into my own deals and to see if I can sell some real estate for commission on the sides. Cameron Academy taught me a lot of things. It taught me different things that I didn't know about real estate. It cleared up some misconceptions that I had. Michael was a great teacher. He taught me a lot about real estate that I didn't know, and it just opened my eyes a lot more and made me just very motivated to get into this. And I think anyone should go to Cameron Academy.
Mi nombre es Rolly Peralta y acabo de terminar las clases aquí en la Academia Cameron con el profesor Michael. He aprendido mucho y estoy muy agradecido con Michael por todo lo que me ha enseñado. Yo quiero ser un real estate agent para seguir invirtiendo en el futuro y también ayudar a algunas familias a adquirir sus sueños. Estoy muy agradecido con Michael y invito a todas las personas a venir a esta academia.
大家好，我叫 Rudy 我很开心能够跟 Michael 上学，因为他在real estate 这方面学到了给我很多知识，我也很开心能够选到他，因为不是每个人都可以教你，他能够教你的东西，他有很多的实力，有很多的经验，而且很风趣，所以对于我来讲是一件非常幸运的事情。那我个人想做房地产投资，所以我必须要有最专业的知识去帮助我自己。很幸运的能够选到 Michael， 所以我希望大家以后能够给他一个机会去跟他做投资，不会让你丢钱，这个很重要。所以祝你们好运，希望能以后见到你们，谢谢，拜拜。
Okay, camera's on. Elijah, Shirley, Hubert, Dominique, Susie, Michaela. All right. We're still in unit 13. And we're on go to page 311. We see the primary mortgage market Probably you haven't heard about what the primary mortgage market actually is, but it's very simple. It's where loans are originated. See right here. Consists of lenders that originate new mortgage loans for borrowers. And there's options on where you can go to originate a loan that you can utilize to acquire a property. You can go to savings associations, commercial banks, credit unions, and they each have types of loans that they prefer to give: residential mortgages, home equity loans. Commercial banks like to give construction loans for residential commercial projects, and credit unions. Nonprofit organization, I always find that pretty interesting and hilarious. True nonprofit, aren't they? And they provide financing for residential loans, home improvement loans. But what I'm describing to you are depository lenders. So they provide banking services to the public, where you can go and open up a bank account, savings checking account. They also originate loans, provide loans for borrowers. But then we come across, look at this chart, we see a non-depository option, which are called mortgage lenders. So they don't provide banking services to the public, but they do originate loans, and they prefer to give residential commercial mortgage loans to the public. Primarily FHA and VA, because they are government-backed loans. And why not give loans that have somewhat of a protection? Go to page 312, and we see mortgage lenders once again. And it's up to a mortgage brokerage company to have relationships with various lenders, including mortgage lenders, to provide options to prospective borrowers on what type of programs they might be interested in, what programs they actually qualify for to get the most attractive terms and rates. You mentioned this, working with a mortgage loan originator who's active with a mortgage brokerage company. And as I mentioned, this is an additional license you should definitely acquire. And if you really want to get crazy, get your insurance license. It's called your P&C license, property and casualty insurance license. So you can not only help your borrower, get financing, purchase the property, but also obtain homeowners insurance. And you can make money off of all of that. If you go to the next page, page 313, we just got done talking about the primary. What do we see here? Yeah. What is a secondary market? Look at the end of line 4. It's an investor market that buys and sells existing mortgages. What's the whole purpose of this? What's the purpose of their existence? If you look up here, I'll make it simple. If I'm your lender and I'm giving out 30-year mortgage loans and I keep on doing this, eventually I'm going to run out of what? I'll run out of money. So what's the alternative? If my money is tied up with all of you, but I know there's more attractive, more lucrative investments I could be making, what is it, the waiting game? No, what I can do is I can bundle your debts together and I can sell them in bulk to one of 3 agencies who I know their sole purpose is to buy up existing loans from primary lenders. And who are these agencies? Well, Fannie, Freddie, and Ginnie. It's not actual people, but you've heard of Sallie Mae. A little bit different. That's for student loan debt. But here we have Fannie, Freddie, and Ginnie. These are just nicknames. It's not actual people. The official name we'll talk about in just a moment, but there's more to it than what I just mentioned to you. At least what the book will tell you. If you go back real quick, it says the secondary mortgage market accomplishes 2 important objectives. Circulates the mortgage money supply. It's what I just mentioned to you. It frees up capital that lenders are tied up with, right? They're giving out loans to multiple people. It gives them an option to liquidate some of those holdings, those debts, so they can make other investments. And it also standardizes loan requirements. You think that the loan requirements for you to obtain financing from a lender actually come from Chase and Wells Fargo and BOA? No, they come from these 3 agencies who promise that if you originate a loan with a borrower that meets these qualifications, we'll buy that debt from you. So they're thinking, okay, I'm going to make sure that when they submit a loan application through underwriting, they meet this criteria from this agency, because I know I don't want to hold on to the debt, or at least I want to have the option that I can liquidate it at any time. That's my option, and that's the game I want to play. So the qualifications don't come from Chase, Wells, it comes from these three agencies. Maybe you didn't know this, but I'm trying to enlighten you a little bit. If we talk about these three agencies, the first one is Fannie Mae, but the official name, that's Sally. Fannie Mae is Federal National Mortgage Association. We abbreviate FNMA. You can kind of see how they got Fannie Mae out of that, right? FNMA, FNMA. There's a few features you should know about Fannie Mae. It's the oldest out of the three agencies, and the sole purpose is to buy up existing loans. And Fannie Mae has no preference on what type of loans they like to buy. They'll buy any type. And you'll even see it on the next page in that chart. So he buys conventional, purchases government insured and guaranteed. Those are FHA and VA loans. So that covers the full spectrum. Now, Freddie Mac, if you look below this chart, the official name is FHLMC. Don't ask me how they got Freddie Mac out of that name, but I can kind of explain it. Fed, the Fed, right? Federal Fed. Fed, Fred, rhymes with Fred. Freddie Mac and MC, Mortgage Corporation. Anyhow, Freddie Mac likes to buy conventional loans, mainly from small banks, credit unions, savings associations. That's their preference. Each agency has their own preference on what type of existing loans they like to buy. And Ginnie Mae. Ginnie Mae has a few features you should be aware of. You'll be tested on this. Ginnie Mae, Government National Mortgage Association, likes to buy loans exclusively backed by the government. That's what? What is government insured? What program is that? Loans that are insured by the government. What program is that? FHA. And loans that are guaranteed by the government, what is that? VA loans. And why not? Because they're backed by the government. And actually, this is the only agency out of the three. You'll notice if you look at the chart, they're a government agency under HUD. And for that reason, look at the last sentence, carries the full faith and credit guarantee of the U.S. government. Some fun facts. Let's continue on. If you move on to the next subject, this is on page 315. We see the Federal Reserve, what? Commonly known as the Fed. Have you heard of the Fed before? The Fed is the central bank of the United States. Did you know this? And it says they were established by Congress in 1913 to create a more safer and more stable monetary system, banking system, money system. They're doing an impeccable job, right? If their whole purpose is to stabilize, to make sure we're not too good for an extended time period, that's inflation, or too bad for an extended time period, that's a recession, their goal is to keep us at a happy medium, 2-3% inflation every single year, that's manageable. What's going on right now, right? We're trying to fight inflation. But in my opinion, it's all fabricated. It's all by design. And if you know what's happened in the past, it's a trend. Everything is a bubble. We've learned that everything is a bubble. Even something they said would never be a bubble, the housing market, we learned in 2008, that's even a bubble. Stocks, bonds, everything. And sooner or later, the bubble's going to what? Burst. And the only way to benefit is to know when to get in and when to what? And you don't think the government influences changes in our market that will put us in a bubble state or cause a bubble to burst? And we call that insider information, insider trading, right? And then you see these politicians benefiting from these, being the best stock traders in the entire stock market. How so? Nancy Pelosi and all these people making billions or hundreds of millions of dollars off of stock trades from insider information. It's got to stop. And hopefully it will stop, because it's not fair to the public. If you find out that they're going to impose some type of charge against MasterCard or Visa, and then right before that is announced to the public, you dump your Visa and MasterCard stock, of course you're going to win. Or you short the market, right? That's how you win big. But I can tell you, if you study trends, if you know what's happened in the past, you can expect what's going to happen in the future. I'll give you an example of this one trend that comes to mind. At the end of every presidency, what tends to happen to gas prices? Can you guess? No. Gas prices go down at the end of every presidency. It's a trend. Study this trend, you'll see. And then when a new president takes office, what tends to happen to gas prices? They go right back up. At least in their first term. In the second term, it might be a little bit different. Okay, change of regime and so forth. So something you have to be aware of. But if you know that trend and you know it's consistent, then why aren't you going out and buying ExxonMobil, BP stock, and stock in these oil companies when prices are down? Because the only way to benefit is buy low and sell what? You've heard of that phrase before, right? Now, I always was confused. I go deep into the rabbit hole. Forgive me for this, but I do believe in financial literacy, and I think you believe it's important as well. And I think it's important for this to be the foundation for you, but continue learning and understand this money game that exists. Some people play it better than others. So I was confused why we always had this continuous cycle. Every 30, 40 years, we do exceedingly well. Inflation, a bubble bursts, whatever the bubble is, and we're right back in a recession, depression. Why can't we get our act together and make sure we're stable over a long time period? Black swan events is what they call them. And so, unforeseen. I think it's all fabricated once again. But the point is this. I studied this information. I did some research, and I saw this interview with one of these very secretive but influential and extremely wealthy, generationally wealthy families. We're talking about, just to name a few, the Trilateral Commission, Jay, Pierpont, Morgan, Rothschilds, Rockefellers. They might go by a few other names, but I'm not going to get into that because we don't need to do conspiracy theory here. But I'll give you fact. It says in 1913 that the Fed was created by Congress. Of course, Congress had to push it through, this concept. Instead of having this money system that anybody could have influence over and control over, let's create a centralized money system, the Fed, so we can have ultimate control. So they had a secret meeting, those names I just mentioned, those influential families, wealth beyond measure, to create the centralized money system so they can have ultimate control. And they already controlled most of the nation's wealth. Railroad, transportation, oil, steel, real estate, banking. We want more control. So let's create a central, everybody has to answer to us. And they pushed it through Congress, and it still exists today. This is why cryptocurrency is so popular. Cryptocurrency is a decentralization of the money system. So we're not, locked down to this one methodology of utilizing money or how it's lent out and the control being under the government's thumb. It brings money, or what we perceive as money, digital currency, back to the people. So we have more control over it. But now there's more regulation that comes along with it. I don't know if you've been paying attention to the market. Okay, so back to the point. I'm doing a weave. I'm weaving in and out. So I had this question on my mind. Why do we always have this cycle? And they interviewed one of these influential members. I think it was one of the Rothschilds. And they said, why do we have this continuous cycle? Exactly what was on my mind. They said, how do you think the next generation of Rothschilds can build their wealth? If we do exceedingly well over decades and decades to come, if there's no correction in the market, if there's not a black swan event that causes the market to collapse, a bubble, how do you think the next generation can build their wealth? So every 30, 40 years, what happens? The next generation comes up into adulthood and so forth, and you got to buy low and sell high. That's the only way to win. So when they inherit all this money, they get all this trust fund money, they got to spend it somewhere. Well, black swan event, things crash, scoop it up cheap. Have you noticed all the billionaires in our America? They're hoarding money. They're hoarding cash. Have you been paying attention to this? I'm trying not to get into conspiracy here, but I'm really tempted to because of the type of stuff that I pay attention to, and hopefully you guys will start paying attention to it. Billionaires, we're talking about who just recently sold a lot of their stock. Elon Musk, Jeff Bezos sold billions and tens of billions of dollars worth of their stock. You know who Warren Buffett is, right? Warren Buffett, one of the richest individuals on the planet. Berkshire Hathaway is sitting on a stockpile of almost $200 billion cash that they can deploy at any moment as soon as the market crashes and win big time, buy up companies for dirt cheap. So they're anticipating, what is that telling you? They're anticipating what happening? A crash. If they're stockpiling cash, they're on the sidelines waiting for things to correct tremendously. Everybody's been waiting, but you can't time the market. But eventually it's going to happen. So where do you stand in that thought process? How do you prepare? It's just something to consider. Anyhow, sorry, you gotta pull me back down from the clouds. I just had a wonderful meeting today that you would appreciate. I met with Scott. What am I talking about? Scott Howitt. Do you know who that is? OCPS, Director of Communications for OCPS. We had a really great conversation. And what I've been talking about you know who Maria Vasquez is, okay? So Maria Vasquez, she's part of that executive team for OCPS, Director of Communications for all of Orange County. Did you know Orange County school system is the 8th largest school system in the nation? Think about that. That's crazy. But anyhow, I had a great conversation with him because what I've been asking for years is to collaborate with OCPS to bring this education to high schoolers and even advanced education because they do offer those programs, technical colleges and so forth. So we had a great conversation about that, and we'll find out at the new year if we can actually, I told you, it's my agenda to bring this education to youth. I'm a big advocate of that. So if you have any, if this interests you and you're serious about making a change and so forth, and you have any pull over there, make sure that you say, hey, listen, get this class, because it's things you want to know about. Before taking this class, you're thinking, I don't know what I'm getting into. Hopefully it's okay and I learned something. But have you been learning a lot throughout this 2-week session? Is it intriguing to you? Are you thinking after taking this class, like, shouldn't I know this? What was that? Yeah. It's stuff you're thinking, I should know. Why wasn't I taught this? I should know this because I want to be a homeowner, or I am a homeowner. Why didn't I know this beforehand? Oh, rely on a real estate agent? No, I want to learn. I want to educate myself, but you're in the right place. So 100%. Oh, so in the meeting, what I found out was with Maria, she said that they're now injecting financial literacy. It's required in high school. They have to pass a financial literacy course for high school. That's new and that's amazing. I can't believe that. I mean, I can believe it because it should have been implemented a long time ago, but it's great that they're doing it. So that's awesome. No idea. Yeah. There's only so much you can do. And then they blame you. They're like, why isn't my credit score 800? I gave you $50.
Getting everything off, and then she had one credit card that was in good standing.
Yes.
That credit card is helping you build your good credit.
Yes.
And she just she goes, I want you to get this off my credit. You can't do that. Why would you do that?
Yeah. You need that established history. It's unfortunate. But it's unfortunate how that works, right? You think you would be rewarded if you remove that debt obligation, that credit limit that could hurt you. But, oh, no, you have all this history, this good history, so you don't want to lose that as well. So it's a double-edged sword. All right, now let's get into some federal law regarding financing, lending money. They're covered under the Consumer Credit Protection Act. The first we see is ECOA, Equal Credit Opportunity Act. What is this all about? By the way, this is enforced by the CFPB. We saw them in a previous unit, ILSA, Interstate Land Sales Full Disclosure Act. But regardless, when it comes to credit and financing, you can't discriminate for most reasons, even age. Do you remember we got away with discriminating against age in a previous unit, Unit 8? Housing for older persons, but not for credit. That means if you're an 18-year-old and you meet all the qualifications to get a loan, they can't deny you because you're so what? You know. And then on the other side of the spectrum, if you're a 90-year-old and you want to get a 30-year mortgage loan, they can't deny you because you're so old. They cannot. Even though in the back of their mind they're thinking, are you going to be around long enough to pay us back? And it's like, let's make up another excuse why we can't give you this. Anyhow. By the way, look on line 23. ACOA was created under the Fed, specifically through Regulation B. That's how they describe it. You have to know that. You'll be tested on that. But what helped me remember this was thinking about the name. Equal Credit Opportunity Act. It's all about being equal. Be equal. Regulation B. That's the connection. And if you go to the next page, you'll see more protected classes that cannot be discriminated against when offering financing. What about your marital status? What about single parents with kids? Sources of income that could be used to qualify for financing include alimony, child support, public assistance income, part-time employment. Very interesting. And then pregnant mothers, childbearing, cannot be discriminated against when trying to acquire financing. The reason why this is a thing is because it used to be an issue. Like my grandmother, I hear stories about when she was trying to get a home here in Florida, and nobody wanted to give her financing. Nobody wanted to sell her a property because she was a single parent at the time and she had 6 kids. And they're thinking, no way do we want 6 little kids in this neighborhood. There was things that are silly to discriminate against, but they were discriminated against in the 60s and 70s and so forth. Very interesting. Truth in lending. TILA. That's how we describe it, TILA. TILA, I like to call it the Truth in Lending You Money Act. The truth in lending, because that's what it's all about. True costs of obtaining financing. Tell me the truth when you're lending money to me. Tell me what's going into, what am I paying for as a borrower? That's what's disclosed to us, and federal law requires this disclosure. You'll see details of it in just a moment. I'm going to show you. But this was implemented by the Fed under what letter? Regulation what? And what helped me remember this is the name, TILA. This is what helped me remember. TILA the Godzilla. TILA the Godzilla. Regulation Z. But you're probably wondering, okay, Michael, what truths are given to us? What's disclosed to us as a borrower when obtaining financing? Go to page 319. You'll see right here, annual percentage rate of interest. The costs of credit, including total cost of the loan, amount financed, total payments, number of payments. All of this is relevant, and obviously we want to know about this. What are we getting into when we're obtaining financing? That's what's disclosed. It also protects us against bait and switch advertising. Have you ever heard of bait and switch? Companies, they bait you in with an amazing deal. When you get there, they say, oh, I'm sorry, it's not available, but you're looking for this product. I have something similar that I can show you. Since you're already in the doors, let me try to switch you for something else. Car companies are infamous for using that strategy. Obviously, it's illegal because bait and switch is a type of false what? Advertising. And if you could prove it, they could be liable. So have you ever seen those advertisements on TV or listened to the radio? You hear car companies, no money down, interest rates as low as 0% for the first 6 months. Dun, 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 dun. And at the end of the ad, with somebody talking a million miles an hour, and if you don't have something to slow it down, you're never going to hear what they actually say. But that's the fine print. That's telling you what you have to qualify for in order to the requirements to qualify for these no interest loans and so forth. What I'm describing are triggering. Triggering terms are used in advertisements, various forms of ads, to catch your attention. Here are some examples on these bullet points. You'll notice they contain numbers. All of those contain specific numbers related to financing that they're offering. Number, amounts, percentages. So if they're using specific financing information in the ad, like 0% for the first 6 months, specific numbers of the financing they're offering, that's when it requires them to provide this additional disclosure. And they're not regulated on how quickly they say the disclosure. That's why they're talking a million miles an hour at the end of the ad. Or if you're watching TV, you see a quick flash of the tiniest little letters you've ever seen in your entire life. And when you read it out, it's probably too good to be true. So this is the type of disclosure that must be given. Disclose the following. Class exam question pertaining to this. Every time you learn a rule, you learn the exception, and here's the exception. If you're using general phrases in your ad, you're not including numbers, specific amounts, like 3-bedroom, 2-bath property. The owner of the property is willing to provide financing. All you're saying is that seller financing is available. You're not giving specific terms, rates, conditions, and so forth. So it doesn't require additional disclosure beyond that. And lastly, for TILA, for the Truth in Lending You Money Act, we see it gives you a right of rescission, the right to cancel the sale contract or financing. And it's a cooling off period. This is how they describe it. And it gives you how many business days to cancel? Yeah, 3 business days to cancel financing from essentially the closing. But it's not for, does not apply to loans to purchase or construct a home. Only applies to these 3 types of financing that you should remember for exam purposes. We see home equity loans, second mortgages, refis, home improvement loans. So imagine you get a home equity loan or a line of credit and you close on that loan. You sign all the financial documents to say, I'm going to get this loan. Beyond that, you still have how many business days to cancel and not move forward with it? It's called the cooling off period. And that's why they won't give you the money for that cash out refinance until the 3 days pass. Then we come across the final federal law that we're going to see in this unit. It's RESPA. Have you ever heard of this? Do you remember RESPA from a previous unit, Unit 5? The last time we talked about this was in regard to referral fees, kickbacks in our business. Do you remember we said RESPA prohibits certain type of kickbacks in our business? Like if you refer business to a title company, they can't give you a kickback. Referral. You refer business to a lawyer, an appraiser, they can't turn around and give you any type of money as a referral. RESPA prohibits this. Now, RESPA was implemented by the Fed under what regulation, what letter? Yes, and you have to remember that. So what helped me remember this is calling it REXPA. You see that? Put an X in the middle, REXPA. Little mispronunciation. And if you notice on line 40, it says this law is designed to ensure that borrowers are informed regarding the amounts and types of expenses that they're going to pay at the what? At the closing. How important is it to know what closing costs are actually going to be before you close? Yeah. Yeah, if you don't bring enough, what won't you do? You won't close. And if you can't close, that means you're not ready, willing, or able. What could you lose as the borrower, the buyer? You could lose not only the contract, but your what? Your earnest money deposit. The seller could claim that for wasting their time. Now, the rule change, October 3rd, 2015, there's a new rule change. TILA and RESPA have been integrated in one disclosure that's called the TRID. It's a big change in the business. And what is this rule change mainly all about? Go to page 321. It has to do with disclosure. You'll see it here in this chart. This is the last thing for this unit. So check this out. On the right, we see timing requirement. As a borrower, when you submit the loan what? Application, the lender, within how many business days, must give you a loan what? Loan estimate. What the loan is possibly going to cost you. It should fall within 10% of your exact amount, what you're going to be responsible for, but it's an estimate, and that's given within 3 business days. I like to call this the loan estimate. Write this down. Add this. This will help you for exam purposes. Loan estimate disclosure. Because if you call it the loan estimate disclosure, then it creates this useful acronym, which is what? LED. You've heard of an LED light, right? It's just easier to remember. But that's the estimate. When, you might wonder, do you receive your exact closing costs? It says at least how many business days? Before the what? Before the closing. And it's broken down on something called a CD, which stands for what? Yeah, and of course, CD is easy for us to remember. You know what a compact disc is? LED light and a compact disc. Easy to remember. You're not too young to know what a compact disc is, right? You know what a CD, okay, all right, just making sure. Any questions here? We're done with this unit. We're done with this unit. Longest unit in the textbook. I didn't sugarcoat it. I mentioned that to you, right? But we got through it. Not that bad. It's because we utilized our time wisely. We didn't take a break right after the review. We went right into that unit. But let's continue to Unit 15. Unit 15 is the shortest unit in the textbook. It takes me about 5 minutes to cover. Don't try to time me. And at the bottom of the first page of this unit, page 351, our first subject, line 19. Let's learn about physical components or characteristics of what? Real estate. Number 1, our product is immobile. Well, duh, if our property doesn't sell well in Lake Nona, you're not going to move it to Orlando where you think it's going to sell better. Or Lake Nona is Orlando, technically. Kissimmee, if you think it's going to sell better. Even if you can physically pick up the structure and move it, what about the land it's sitting on? Can you move the land? Can you destroy the land? No, land is durable. That's how they describe it. Indestructible. And real estate is what? Yeah, there's no two properties alike. There's a term we use to describe this. You might see it for your homework tonight. It's called properties being non-homogeneous. Non-homogeneous means there's no two alike. Homogeneous means they're all alike. Let's continue on. We talked about physical, and now let's talk about economic characteristics of real estate. So you know I'm not really pumping this conspiracy stuff, and I'm not lying to you. It's in your textbook. Who has ultimate control? The government controls, influence the market. Wow. Through zoning, taxes, monetary policy, and so forth. Look on line 17. Do you know the relationship between supply, demand, and how that affects price? If there's a large supply of something and little demand, what tends to happen to the price? It goes down. Think of a can of Coca-Cola. There are everywhere, right? It's not hard to find one. A can of Coca-Cola is cheap. Versus high demand, little supply, what tends to happen to the price? Of course, you have the last ice cold can of Coca-Cola in the middle of the Sahara Desert. Mad Max, okay, is going to change what that value is. But our market, the housing market, we're not talking about Coca-Cola anymore, we're talking about real estate. Is our market slow or quick to respond to changes in supply and demand? It's slow, as we can see, based on this feature, this title. So what's happening to us right now? If you've been in the business and you pay attention, we already saw this coming. We knew 2% interest rates, 3%. It was just spoiling us. It was not sustainable, and eventually rates are going to go up, and it's going to cause some changes in the market So we prepared for it. We refinanced our houses like I did. We took advantage of those low rates and so forth. A lot of people did not. And then we come across the most important feature to determine value in real property. It actually comes down to three things: location, of course. We use a term to describe this. It's called situs, S-I-T-U-S, area preference. It's based on where we as home buyers like to live, based on job opportunities, schools for our kids, crime, everything, all of the above, population, pollution. Let's go to the next page, page 353. Highlight the shaded box. Let me ask you a question based on the shaded box. Do we as consumers have influence over the supply of housing in our market? No, because
Your mic went out, Michael.
go. Okay, you can hear me now? Good?
Yeah.
Okay, cool. So we as consumers do not have influence over supply because of skilled laborers, construction loans, financing, land and materials. But we as consumers do, on the next page, have an influence over what? Starts with a D. Demand, because look at the list. This is all about us. Price, population, what we qualify for, our income, taste, preference, situs. You might only get maybe one question on your state exam from this unit. For your class exam, this is the one question. You have to know the definition of a household unit, but we already learned this on day one. When we talked about the definition of residential, 4 units or less, on how many acres? 10 acres or less. What's a unit? Talking about a household unit. It's a dwelling space where a family can have privacy, a separate dwelling space. You'll see that here. And that's how the U.S. Census Bureau defines a household. Separate housing space. But let's move on. Let's go to the next page, page 355, line 32. We see a what type of market? And then on line 35, we see a what type of market? What's the difference? A seller's market is good for who? The seller. Okay, it's not a trick. But when does a seller's market occur? When there's more what than what? More demand than supply. Now's the time to sell it because you're going to get the most for your investment. And then a buyer's market, when does that occur? More supply than demand. You have more room to breathe and negotiate and get a better deal. Well, that's the question. What do you think? What type of market do we think we're in right now? A buyer's market or a seller's market? I'd say we're still transitioning out of a seller's market into a buyer's market. I just had a conversation with Joe. You saw Joe when he passes through and leaves for the day. He mentioned he just looked at stats and we're like almost like at an all-time high for inventory. So you could be picky and you can go after these deals. I have property that I'm listing right now, but my objective is I want to keep the property. So yeah, I have it listed at a high amount. If somebody's willing to pay the price, great. If not, I don't care because I want to rent it out anyway. It's not what my wife believes. She's like, sell it. But anyhow, we're done with this unit. Yeah, it's unit 15. So the question I have for you is, do you mind if we knock out one other unit? Don't mind? Okay. I'll knock out a unit that probably takes just a little, maybe 10 minutes to cover. And it's unit 19. Let's cover 19. Since we have some time, why not get ahead of the game? And beyond that, unless you're willing, I try not to cram too much down your gullet, but Unit 19 is quick. So planning, zoning, environmental hazards. Last unit. I mentioned we're going to cover all units. And if you go to page 430, specifically line 10, our government has this philosophy when regulating businesses, and it's French. Do you see it? Laissez-faire. Yeah, it means let it be, let it alone, right? Laissez-faire. Thank you. I appreciate it. Your pronunciation is spectacular. So our government, they let us run our business the way we want to. They let us be. Of course, they tax us, but we're not a communist country that says you have to run your business like this and do it our way, and you can't do this and you can't do that. Anyhow, luckily, capitalism. Just to set the tone, go to the next page, page 431, line 1. Local governments, municipalities, counties establish development goals called a comprehensive what? Yeah. Just in case you're not familiar. I'm just telling you the most important parts of this unit. Let's go to page 432. And under authority, we actually talked about this on the first day of class. There are 3 areas of responsibility delegated to the City Planning Commission. Subdivision plat approval. Do you remember the subdivision plat map? You have to submit these plans to the local government, get them approved before you can advertise or sell. Site plan approval, and the actual signage, the entrance sign for the community that is regulated for commercial property, businesses, and so forth. Very interesting. Go to page 434. If I'm not explaining it, it's something that you don't need to know for personal reasons, to protect yourself and others, to comply with law, and you're not going to be tested on it. So stick to the most important parts of each unit, including what we see on page 434 under zoning ordinances. Zoning ordinances, line 3, are local laws that implement the comprehensive plan, the development goals of the city, county, municipality. And we talked about this in a previous unit. Police power represents the broadest power of the government to limit the rights of property owners. But let's talk about zoning classifications. Residential zoning regulates what? Controls what? Density. Or in other words, the number of homes that could be built per acre. And then you're thinking about these communities that exist, like in Baldwin Park, Celebration, and Laureate Park and Lake Nona, where the houses are, I mean, you can hand your neighbor a cup of sugar, give them dap. They're so close to one another. And it's just no privacy. But what they did was they submitted the plans and they thought high density was a good idea. Of course, the developer loved that because now they can build more with less land. Commercial zoning regulates intensity of use. That means you can't just build whatever you like, wherever you like. Do you know everything has its place? That's what zoning is. Commercial zoning, residential zoning, houses could be built here, shopping centers could be, warehouses can go over there. So even though it's zoned commercial, you might not be able to put whatever business you want. That's regulated as well. That's why you have different levels of commercial, C1, C2, C3. If you want to open up a gun store, you can't just put a gun store wherever you want. A liquor store, a church, a school, everything has its place. And that has to do with zoning. Let's go down to building codes. The whole purpose of building codes is to prevent inferior construction, to stimulate quality of workmanship, and so forth. You had a question? What did you say? Yeah. Well, we talked about it briefly, but it didn't go into why building codes exist. We just said that you could sell a property as is with a code violation. But this tells you why building codes exist, why you need a permit to enclose the patio in your backyard and so forth because they want to make sure it's not going to fall apart. Quality of workmanship, construction standards. So how do they enforce this? How do they regulate this? Go to page 435. Look on line 14. Who enforces building codes? Yeah. By issuing building permits after they review your architectural and engineering drawings. Architectural is how it looks. Structural is, engineering is the structural integrity, making sure it doesn't fall apart. So local governments say, hey, listen, it's got to look like this if it's going to be in this area, and it has to be structurally sound. So show me your plans, show me the materials you're going to use. We'll approve it. We'll give you a building permit. You start the construction. When you're done, let us know. We'll come and inspect it and close the permit. This is how it works. Go to page 436. This is interesting. If you want to get permission to do something with your property that it's limited from doing, you have to request something called the variance. It's by submitting a variance application. You want to build a fence closer to the road, but you're not allowed to build within a certain distance of the road. You have to get permission to do this. It's called a variance. You have to submit a variance application. But you have to prove that a hardship exists. Must show hardship exists. Some people struggle with that. You have to be very clever sometimes. Hey, listen, I have to build closer to the road because it's a security risk. I got to enclose my property. Really, you just want it because you want to enclose more of your property, but you have to somehow justify why you're doing it. Okay, go to the next page, page 437. We see legally non-conforming uses. Best example I can give you of this, and I'm pretty sure most of us have seen it before. If you drive through a downtown area, downtown Windermere, Winter Garden, Kissimmee, Orlando, have you ever seen something that looks like a house, but it's turned into a law office or a medical practice? And you're like, what's going on here? Does it have to look like a house? Is that the requirement for the area? No, it used to be somebody's residence because people used to live in the city. But of course, population expanded. There was a demand for business use in the area, so they said, we're changing this area to commercial. Now, legally, U.S. Constitution cannot force them out, cannot force them to comply if they are what on line 5? Grandfathered in. Have you heard of being grandfathered in? It means you existed before zoning changed. And that's where the name comes from. If we break down the name, it makes sense. You're legally not conforming, not complying with what it's now zoned for, used for. So you are allowed to continue using it as a residence, even though the area is commercial, because you're grandfathered in. They can't force you to switch. But if you switch to the current zoning, you can't go back. So that's what they did way back when. They said, hey, listen, this area is commercial now. We're not going to force you out. You can use it as residential. You can sell it as residential. But if you rent it out to a business, we find out you're using it for business purposes, it's commercial, you can't go backwards because that's what we wanted anyways for the area. All right, and go to page 440. Let's talk about environmental hazards associated with real estate. Environmental hazards. Asbestos. You know what asbestos is? It's a fiber material. Okay, so decades ago, we used asbestos in building materials because it didn't catch fire. It was flame resistant. They call it flame retardant. I think you'll even see that here. Yeah, fire retardant, which means you couldn't burn it. So the dream was, if we can put this in everything, we can construct a flame resistant house that doesn't burn down, even though we're making it out of wood and so forth. We just spray this material on it, use it on this, and it won't burn down. That's an amazing idea. However, they found out the fibers cause cancer in the chest cavity when inhaled and so forth. Do you see it right here? So if you're selling a home built prior to 1978, you might want to check if it has asbestos. You can easily get it tested, and there's companies that you hire specifically to remediate. They'll come in with hazmat suits. You know what a hazmat suit is? Like a spaceman suit. So they can remove it and they'll give you a certification. We talked about radon gas. Any questions? We talked about lead-based paint. Any questions? And it's for homes built prior to 19 what? You have to give the LBP disclosure. Go to page 441. Do you see mold? Has to do with air quality, right? And it could, if you have a mold problem, you know, right? You walk into a property, you smell it. You know that mildew smell. It hits you in the face. And you can easily look for the areas that might have mold, a mold issue. You look in the wet areas. You look in the bathrooms, underneath the cabinets. You make sure there's not a leak. Look around the faucets and so forth. Go to the kitchen, underneath the cabinets, the AC unit. If you see the black dots accumulating on the handler and so forth, you can spot it. And you can even get the home tested. It's part of your inspection period. And if it does have a mold problem, you can say, hey, seller, you got to fix this. Otherwise, I'm going to back out. You could easily fix it, but you got to get on top of it immediately. You can't mess around. Usually it stems from humidity and wet areas. So if you have a leak in the property, you have to address it immediately. You can't mess around with water problems in Florida. Otherwise, it causes mold. It's inevitable. It thrives. Mold thrives in our environment. Tropical. And it spreads. Not all mold is hazardous, but when it becomes sporous, it could give you asthma. It could trigger allergies. It could black mold. If it gets in your lungs and accumulates, it could kill you. Water supply. You have to disclose this to the prospective buyer. Where are you getting the water from for this property? Is it a well or is it public utilities? That's important to know. And then also, where does sewer go? Where does the wastewater go? Public utilities, like a sewer system that is connected to, or do you have on-site disposal of wastewater? You know what on-site means, right? A septic system. You know what a septic system is? You got a tank that sits below your lawn, and then you have something attached to it called a drain field. So the tank collects both solid and liquid. The liquids get distributed through the drain field, and the solids are broken down inside of the tank. You know what I'm talking about, right? But you got to know beforehand, because septic tanks are fickle. And if you're not aware of this, you start flushing those disposable wipes and things you shouldn't be flushing down the toilet. It's going to clog up the system. And with septic systems, they could kick backwards and push all the poo water into the house through every drain. Just so you know, okay, it's a horror story. If you ever experienced this, my sister, she when she first moved back to Florida, she was living in Texas, and I convinced her to come back to Florida, and she was renting a place that had a septic system. She didn't know. She never lived in a house with a septic system. And then I saw I went to go visit her, and I saw on top of her toilet, she had disposable wipes. I'm like, you're not flushing these down the toilet, are you? And she's like, yeah, what's the problem? I said, you can't do that with the septic system. She didn't listen to me. All of a sudden, I get a call at midnight. There's poo everywhere. Oh my gosh, it was a disaster. And the house completely it kicked backwards, and the poo water came through the faucet, the drains, the tubs, everywhere. Disgusting. Horror story. What was that? Burn the house down, right? Do you know what? Okay, if you're selling an older wood frame house, if you're listing it, then the lender will most likely require a WDO inspection. It stands for wood destroying organisms. Terminex, Truly Nolan, these companies are certified. Pest control companies are typically certified to do this inspection, but they do it because they want to find a problem and charge you for a service. Oh, we'll take care of any infestation and treat it and give you a 5-year bond. That's what they want to sell to you. But the lender might require that 5-year bond because it's an older wood frame house. If it's an older wood frame and you don't consistently do treatments, it's almost guaranteed it has termites here in Florida. And it's not just termites. God bless Florida. We have about 8 different types of wood destroying organisms, insects, even fungus, that will destroy the wood. There's beetles. There's carpenter ants, wood boring beetle. There's about 4 different kinds of termites as well. Something to look forward to. And And we're done with this unit. 15 minutes it took me. How you guys feel? You want to throw in another unit? Well, here's the thing. I leave Friday anyway for review and preparing for the final exam. So typically we finish all the units on Thursday. Yeah. But unit 19 is a unit that we don't have to cover now because we've already covered it. What I want you guys to do tonight, tomorrow in the morning, whenever you do the review questions, hopefully you're doing it every single night because I give you enough time, is at least the questions for unit 13. Because these unit 15, 19, or maybe only one question on your state exam from it, very few questions. Focus on unit 13. That's what we're going to review tomorrow for review questions. But if you're up for it, we could take a quick break and then we can knock out unit like 17 if you want. Can't handle it? Okay, too much? If it's not unanimous, then I'm not going to do it. So anybody want to just, we're actually done with our session. We got through everything early and you're still going to get the full amount of credit. How you guys feel? Good? Okay. At least we knocked out one extra one. Good for you. Holidays coming up. Kids are going to be out of school. Anybody have kids? Few of us? Yeah. Anybody traveling for, yes. Traveling for the holidays? Yeah. Where are you going? Texas? Bahamas. Okay. God bless you. That's awesome. Huh? You're going to Vegas. Anybody live out in Vegas that you're visiting or just going to Vegas? Okay. Don't spend too much money. Huh? Am I traveling? Yes. I'm going to be in Mexico. Yeah. I'll be in Mexico for a few weeks. So my wife, she's mi esposa es mexicana. My wife is Mexican. And she has a decent sized family over there. So we got to go visit them at least once a year. And it's exactly what we're going to do. Hey, you guys can come in and take care of what you got to take care of. No, you're fine. We're done. All right. Push your shares, clean up your mess, drive safe. God bless. I will see you. Mañana. Have a great night.
Have a good night.
Bye.
Thank you. Good night.
Better Elijah. Take care, Michaela. That's support right there. All right. Have a great night. Cheers.
In an era where online education often falls short, there's an oasis transforming the digital learning landscape. Welcome to Cameron Academy. With our AI-powered platform, we're not just changing the game, we're rewriting the rules. At Cameron Academy, we're not just elevating education, we're lifting learners to new heights. Our comprehensive video lessons and AI tutors simplify complex real estate concepts. At Cameron Academy, we do more than prepare you for your exams. We equip you with the essential knowledge for a successful career in real estate. Break away from the traditional. Think computerized exams. A convenient study app at your fingertips and AI support, but wait, that's not all. Live chat support when you need it, AI-driven text-to-speech content, your own personal AI tutor, and instant online certifications. This isn't just education. This is the future. We're reimagining what it means to ascend to success in the real estate industry. Choose Cameron Academy, the oasis of innovative learning. Your journey to success starts here.